All right, now we are moving on to the valuation of intangible assets. We've got two processes, two methods. We've got GAAP and IFRS. So under US GAAP, finite life intangible assets, so these are intangible assets that will essentially cease to exist after some time, such as patents, right? Patents are going to expire, are reported at cost less amortization and impairment. So this is carrying value, right? We've seen carrying value before. Carrying value is your balance sheet cost minus amortization or depreciation and impairment. Indefinite life intangibles are reported at cost less impairment. So if you've got, let's say, a patent that is going to last forever, or copyright that's going to last forever, it's going to be reported at its cost. But maybe the brand of that, like a brand is another intangible asset. Maybe it is impaired because there was a bunch of negative publicity about it. So we have to write it down. We have to impair it. All right. Under IFRS, intangible assets can be reported under the cost model or the revaluation model. All right. The cost model, intangible assets are reported at cost adjusted for amortization. This is for finite life intangible assets only and impairment. The revaluation model states that intangible assets are initially recognized at cost, then revalued to fair value at a subsequent revaluation date. Revalued intangible assets are reported at fair value on the revaluation date, adjusted for subsequent amortization and subsequent impairment. So here is the formula for what we will see there. This is going to, I would say that this one generally makes more sense in the real world, right? Like that just kind of is more factually, at fair value. It determines its real value. What about revaluation gains and losses, right? So you have your external auditors come in, you have them tell you, okay, your patent is actually worth more or your patent's actually worth less. Well, let's see what happens. Regular revaluations are important so that the carrying value, this is the current value in the balance sheet, of the intangible asset does not differ materially from the fair value at the end of the reporting period. Again, I've been on audit teams where we have to go in and we have to revalue their assets and say, okay, is this worth as much as you said it was? Sometimes it's more, sometimes it's less. If an intangible asset is accounted for using the revaluation model, all other assets in its class must also be revalued unless there is no active market for the intangible assets. This is saying if, let's say, it's such an obscure, unique, nothing else like it in existence, well, yeah, maybe it's going to be pretty much impossible to revalue it. But most things have at least a comparable comparison to value it to. So let's say we have a revaluation loss, right? We come in and say that the valuation team says that the asset is not worth as much as you are stating it as. Well, the fair value is going to be less than the carrying value. So that loss is going to be reported on the income statement unless revaluation loss reverses a previously recognized revaluation gain. In this case, it's recognized in OCI. Ding, ding, ding. We have seen this before. It's part of our puffier mnemonic and reduces the revaluation surplus in accumulated other comprehensive income. All right. Going to be one of our memorized components of OCI. Make sure you're continually memorizing those and seeing where they pop up throughout the exam. Revaluation gains, how are we treating those? So this is when the fair value on the revaluation date is greater than the carrying value before revaluation. All right, that's reported in OCI and accumulated in equity as revaluation surplus, unless the revaluation gain reverses a previously recognized revaluation loss. Don't stress out too much about everything going on here. I know this might sound like it's a lot. Mathematically, you'll see some questions, practice it through and through. This is just a nice overview conceptually of what is going on, so do not worry too much. Revaluation gains are reported on the income statement to the extent that they reverse a previously recognized revaluation loss. And these are updates, right? This is essentially like technically every day when a stock goes up and down, that's a revaluation, either in a gain or a loss. But what about impairment? This is a permanent write-down. So if revalued intangible assets become impaired, the impairment is recorded by reducing any revaluation surplus in equity to zero with further impairment losses reported on the income statement. Those are our treatments for our write-downs or write-ups. Let's move on.